Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day. Ira Epstein of Linn & Associates with your financial market wrap-up, and this is for Thursday, the 6th of July, 2017, getting on to 3:50 p.m. Central Daylight Time. Okay, the events of the day, a sell-off in the stock market. A great number came out in the crude where we saw 6 million barrel draw just in the crude oil numbers, and all you're up is 18 points. I'd be pretty concerned. That's not the great number there. Natural gas up 5 cents, and you're getting a bounce in a market that got oversold and ahead of itself. But as we talk about all the markets, we're looking at a dollar that is down going into tomorrow's employment numbers. Now, here's how I'm going to view those numbers. The market's looking for 180,000 new jobs and about a 4.3% unemployment rate and wage inflation to have gone up about 1/10 more than it did last month. Anything that is a hotter number than that is probably even more bearish the stock market. Anything that is a softer number, you don't get as many jobs, you don't see the wage inflation coming about, well, that could set the interest rates, which have been gaining recently, and as you can see, they're still doing so. Remember, as they drop in the bonds and notes, real rates are climbing. That'll reverse all that because the market would then say, now we're through with the month of June's data, and it was or wasn't good. Let's assume it wasn't a hot number. Well, that puts September even more in doubt for a rate hike. Make it a real hot number, a good number. You get 200,000 jobs, something of that accord, and the unemployment goes down to 4.2, 4.1. Well, then the Fed might say, that job data is strong. We got to get ahead of the market. We raise rates. That would be bearish the stock market. So we have to see what's going to happen. In looking at the NASDAQ on a weekly area chart, we're in a correction. I was just on an hour ago, maybe a little more than that, an hour and a half on Fox TV with Liz Klayman, and they asked about these markets. And I said, Liz, you're in the middle of summer. You're going into employment number tomorrow. The market, if you read the Fed notes, the Fed was looking to see if they can get a September hike going. I read the notes. That's exactly what I read. If they have a hot number, it might do it. That'd be bearish the market. If they get a soft number, that puts it further off, and then this correction is just a correction, a normal one. Is this the beginning of something big? Don't know, because you got a low volume week. A lot of people are still on July 4th holiday. So you can't get away, though, from the fact that on a chart, it doesn't care about that. It's saying the market's gone from 58.86 to 55.95.5, and it's in a down thrust at this point. When we go to a daily bar chart, and by the way, this is a weekly area chart of closes, weekly. When we come over to a daily bar chart, you can see how the market's been coming down. When we go to the daily swing lines, you see a clear pattern. Lower highs, certainly lower lows to these apexes. That is a bear trend. That's the definition of a bear trend. Lower highs, lower lows. Before I get on to my next chart, I'm going to ask a favor of all you. I've been wanting to do this for years. Would you tell your friends to watch these shows? Viewership goes up. It opens more opportunities for me and for you. That's why I do this, for you and for me. So I ask that you do it. By the way, at the end of this, I have a new product I'm advertising. I've never done this product before. I want you to take a look at it, and it's one I created. Okay. So when looking, you've got lower highs, lower lows into a downtrend. If the market keeps breaking, one of the main support zones could be the 55.53 level, 55.52.75, right in there. The 100-day moving average of closes. On rallies, resistance 57.14.5, the 18-day moving average of closes. I call it MAC. Bollinger Bands. Tell me what number the market's been fighting at as it's been dropping. The lower Bollinger Band. What's the theory of a Bollinger Band? It is an algorithm designed to keep the market trading within them 95% of the time. Some markets like to stay within them a lot. This is one of them. Take a look at how the market gets to it and keeps hitting it. And go back and do your own history. You will see this to be the case. So seeing this market ride it, as I call, that's bearish. I look to see what the slow stochastics are doing, and they're just plain oversold. Sometimes the slow stochastics will get the two numbers going sideways over 80 or under 20. When they're over 80, it's bullish, and you can see that the market often moves with that. When it loses that, as it did right here, sometimes it loses it before prices retreat to that 18-day average of closes. But in most events, that 18-day average, that line in the sand, is what markets like to, after a bear trend, retreat to, or a bull market fall back to. So important to keep your eye on that. When we come to the September Dow Jones, the low today was 21,257. The last break low was 21,232. Therefore, we still have a pattern of a higher high and a low that's under a previous low. Admittedly, momentum turned down today for the first day in a while, and you're under the 18-day average, so you have downside bias. The problem is, I still think you're caught right in these narrow Bollinger Bands, and you got to be careful of that. You can just bounce back and forth in those. In the September E-mini S&P, this is a market that's got a pattern of lower highs, lower lows. The lower Bollinger Band, it looks as though the market's going to settle under that today for the first time. Now, if it settles again tomorrow, you may be headed to the 2381 level. If the market fails to the downside, you probably go back to the 18-day average to regroup. But the trend here, this is the most bearish of the charts. It is not an oversold territory yet, but a steady to lower opening, it will be most likely tonight, the way the math works on that. Now we get to the Russell. The Russell converted itself today to bearishness. Lower highs, lower lows. But when it did it, it immediately went down towards that 18-day average of closes. Didn't quite hit it. I'm sorry, the lower Bollinger Band, not the 18-day. It got as low as 1398.10, and what you've got is 1396, let's call it 70, is the lower Bollinger Band. Momentum is down. Bias is down because you're under the 18-day average, and you've got the swing line down. Everything is bearish on this chart. If it slices through the lower Bollinger Band, possibility of getting to the 100-day average there too. We then get to the VIX. Now, in the recent past, every time you've gotten over this upper Bollinger Band, you've had no more than a day or two period, and you've come right back into the bands. That happened here as well, right back into the bands. You stepped out of them today. Until that pattern changes, I have to assume this market might slip back. If it doesn't, you'll probably start widening these bands out. The higher this goes, the more bearish it is for the stock market. It means people are taking on risk, premium. They're saying, they don't like what's happening, and generally up means stock market down. In the bond market, you are riding the lower Bollinger Band in an oversold condition that has a pattern of lower highs, lower lows. It's bearish, and this is called riding the band. You go to either side of it, and you just seem to lay on that band as you go lower. That is bearish. You might be headed to the 150, 115 level, which is almost a full point away. In the 10-year notes, you today got down, hit the 100-day average of closes. The lower Bollinger Band and the close look to be about the same number where you're at right now. You could get an embedded reading over the next day. If you look today, both numbers are under 20. If you look yesterday, both numbers that make up the slow stochastic are under 20. The day before, they are not. So this market's forcing you, if you think it's going to lock in, to take on a lot of risk going into that employment data from a market that was just 126.29 all the way at new lows here at 124.25 and a half. A little dangerous, wouldn't you say? The dollar index turned bearish today also, with a pattern of lower highs, lower lows, bearish. Markets under the 18-day average, bearish bias, but oversold as can be. So one of the three parts to get really bearish are missing. Go to the euro currency, it's the same thing, but flip-flopped. Higher lows, higher highs, overbought, and over the 18-day average. So, got two flip-flops there you got to be a bit careful of. British pound today turned bullish, but overbought. You've got the higher lows, you've had the higher high, you're over the 18-day average. Big warning sign in all the currencies. You're overbought or oversold, with the exception of the yen, that is just plain bearish as can be. You've got a bearish crossover where the 18-day average in red just got under the 100. Bearish. You've got a market that is in a pattern of a higher high and a lower low and had an inside trading day today. Won't take much in a day or two to say that it rolls and creates another peak. I think the pros will be selling this market unless there's some world event that drives people to safe haven statuses. That's how it's looking. In the crude oil market, the crude is backing off right now out of overbought condition. It got overbought up here 2 days ago. It still has the pattern of higher lows, higher highs. Support was immediately hit yesterday and held at the 18-day average of closes. The problem that you should have is if you buy it, where are you wrong? If you put a stop under a previous swing line, well, you only got a risk there of several $1,000s almost. It's too much. So that's the problem, but the trend is up. And by the way, I find that money management is as good a filter as a moving average, a slow stochastic, Bollinger Band. I've developed techniques for that. Gasoline, higher lows, higher highs, 3 days in a row, hitting the upper Bollinger Band, very overbought, but certainly in an uptrend. Nat gas getting a bounce in a market that is oversold in a downtrend. Lower highs, lower lows, downside bias since you're under the 18-day average. I say the pros are waiting for that market up at that 18-day average, but because you're oversold, it becomes a bit risky of a situation. As I said to you a minute ago, I'm asking you to have your friends take a look. There's something I want to give you. I spent, before I went on vacation, some time creating a mini course for you on in and out trading. Let me repeat that, in and out. The idea here is you're buying, you're getting out of the market fairly soon. This is a 5-minute bar chart. 5 minutes. You can go to 15, but I'm giving you the theories that I'm using. It's called a pivot point. And what a pivot point does is it takes the previous day's range and via a formula that I teach you. I have one video that teaches the formula, and in that same video I create a PowerPoint to show how to use these numbers, how they'll plot on a chart, and then I take you to an actual chart or charts and show you how they apply and what to do with them. So you're going to be finding, to make it really simple, 5 points. I believe in the 5-point pivot point. Some FX traders can take them out more than that. They can go to 6, they can go to 8. There's numbers you can go to from the center of it. But you're finding a white line that's the center, and underneath it, 2 lines, buy lines, first buy, second, first support. It's called S1, first support, second support, S2, first resistance, second resistance. I teach you the theory and how the markets like to play with that accordingly. I even teach you the stop order theory that works on this. So if you'd like to get this, and it's totally free, both videos, all you've got to do is give us a call. Call us at 866-973-2077. They'll all be emailed to you. You can go to our website as well at www.iraepstein.com, and on the carousel of free offers, everything will be there. You can click up here. If you're watching me on YouTube, you'll see an icon. Click it. Our form will come up, or underneath us. If you'd like, just click here for Ira's free offers, and you're going to get these 2 videos on PowerPoints. I'm Ira. You have a good day, and I'll talk to you tomorrow.